there's been debate about whether deposit protection is right for Ghana, whether we need it or not. So I need to give some bit of history to that. It's not a new concept, really. If you look back, the US set up this in 1933. Since then, in Europe, in the 1920s, Czech Republic was one of the countries set it up. Then Germany in 76, Britain 79, France in 1980. The European Union took a decision to make deposit insurance a requirement for all states in 1986. And India, Sri Lanka, and other countries have since moved on. Even in Africa, Kenya established their scheme in 1985, Nigeria in 1988, Zimbabwe in 2003. During the last IAD conference in Canada, it came out that even the Francophone bloc next to us have started a deposit protection scheme. And so what we are doing is not out of place. And the other point to note is that since the global financial crisis, a lot more countries have put in place deposit insurance schemes because they see it as a fourth pillar that can support the three pillars in ensuring a safe financial system. In Ghana, we still have a large number of small, unsophisticated depositors who need protection. We need to continue to promote financial inclusion and increase deposit mobilization. We need to continue to boost confidence in our banking system. And finally, we need to have a way of managing the fiscal costs that arise when a deposit institution goes under. So the deposit protection scheme provides us the opportunity to address these things that I've just talked about. And our journey started quite recently. But also, let me give a background as to why we need the deposit insurance scheme, because we have had experience of distress. Some of us will remember the 23 rural banks that were closed in the early 90s. They had a cooperative bank and the BHC story in 2000. Recently, we have had DKM and Capital Bank and UT Bank. All these developments indicate to us that we have in place the three pillars of prudential supervision. We have prudential oversight in place, we have lender of last resort in place, and yet institutions are failing. So we need more than just prudential effective oversight. We need to put in place other mechanisms that can help us address distress when they do happen. In the absence of an explicit scheme, what happens is that it becomes a quasi-fiscal problem for government. It is in this regard that in 2011, we began the process of preparing the act which was passed in 2016.